Hi, this is Sarah Cage, and I'm joined by my co-host Adam Olson, Embark's National Quality Leader. And today we're going to be talking about all things going concern. And you know what? I can honestly say there were times this year where I wasn't sure if I was going to be a going concern. What about you, Adam?
I hear you there. I mean, I don't think anyone was upset about turning the page on 2020 for sure.
Yeah. So this topic is super relevant because many companies are struggling to decide whether or not they're a going concern due to all the uncertainty this year. Could you start us off by giving a brief description of what going concern actually is?
Yeah, I think from just like a broad basis, I think one thing to keep in mind is that US GAAP actually doesn't define what the term going concern is. Instead, there's a presumption that, businesses will continue, and that continuation is assumed in the financial statements unless, liquidation is imminent, in which case US GAAP has a different basis of accounting, which is the liquidation basis.
Mm-hmm.
So really, like, going concern for the most part is I kind of think of it as like an early warning system. So it's for investors or users of the financials, as management does their going concern assessment, if there's anything to kind of highlight to those users of the financials, the framework for going concern provides that warning.
Like a check engine light.
Yeah, exactly.
Your car's still running, but you better do something to check on it.
Yeah, for sure.
So does this going concern assessment directly affect the entity's accounting?
No. So regardless of the outcome of the assessment of going concern, the ongoing accounting will continue as is. Like I just said, the only change in the way the accounting will occur is if there's the liquidation of the company, in which case the basis of accounting switches to the liquidation basis.
Okay. And so this is kind of a hot topic. Could you go into some of the reasons why that might be this year, more so than in other years?
Yeah, so there's actually nothing new about going concern. I mean, it's a relatively new standard. It's been around for a few years, but there's no change in the guidance itself. I think it's received a lot more increased focus just given the events of 2020 with COVID and declines in economic markets and all of that putting pressure on businesses and companies that we all kind of experienced throughout the year. It's just introduced a lot more uncertainty, and so an analysis or an exercise that may have been otherwise pretty standard, something management knew they had to do, is now having to have like a deeper lens on kind of what they're evaluating and putting more prudent effort into completing those assessments.
Okay. Yeah, because they might have always just no brainer they're going concern. Right. Now there's probably a little bit more evaluation that has to take place.
And a lot more judgment too. And and it's not just management as well. So like auditors, they're obviously, interested in going concern as well. So there's a lot more auditor focus as well. And so, anytime the auditors have increased focus, it unfortunately puts, a lot more undue pressure on management as well, to be just as prudent.
Wow. Okay. So when does a company have to do the going concern evaluation?
So it's required each reporting period. Okay. So for public companies, it's not just on an annual basis, but it also has to be done on a quarterly basis. Then obviously for private companies who maybe only issue their financial statements once a year, they would do that on an annual basis. But to the extent they issue quarterly financials, it would also have to be done during those interim periods.
Okay.
So, and I think one thing to keep in mind is that the going concern assessment is kind of an ongoing assessment. So, there's this concept of a look forward period and a going concern that extends 12 months from the date the financial statements are issued. And so, each quarter it's kind of moving that, goalpost again. So, it's an ongoing evaluation that's done each period.
So they're predicting what's going to happen in the next 12 months. And if anybody knows, let us know, because I'd love to know what the next 12 months are going to look like. Can you walk us through what you actually do as you perform the going concern evaluation? What does it look like?
Yeah, so just from like a high level perspective, I mean, you can really think about the assessment itself into kind of two steps.
Yeah.
So step one is kind of looking at whether or not substantial doubt has been raised, which is more or less whether it's probable that the entity will be unable to meet its obligations as they come due over the next 12 months. If that substantial doubt kind of trigger is met and it is raised, then you move on to step two, which is then evaluating whether or not that substantial doubt exists. And so the existence of substantial doubt allows management to consider any plans that they put in place, and if those plans can mitigate that substantial doubt. And so to the extent they can, then substantial doubt does not exist. But to the extent those plans do not mitigate, then there is substantial doubt about the entity's ability to continue as a going concern. So if you get to step one, you do that assessment, you don't feel like a substantial doubt is raised, you stop there. There's nothing else to do. But if you go beyond that, you have to take it to step two.
Step two. And so you said substantial doubt a couple times in there, and that's just fancy talk for management judgment. We all know that. So I guess how would you define substantial doubt? How could we I guess it can't be quantified because that's the whole point of judgment.
Right.
How can you drill down a little bit in there?
Yeah, so I would say this is probably the tricky part, right? Like you said, there is a ton of judgment that's necessary. The guidance really suggests that you have to consider, and they use this term, relevant conditions or events that are probable, that indicate that it's probable the entity will be unable to meet its obligations as they come due over that next 12 months. So it's really that assessment of all those relevant conditions and events that you have to go through in order to figure out, okay, in the aggregate, as I look at all these things, do we feel like substantial doubt's been raised?
Okay. And so that sounds like it's just going to be a hard thing to really nail down, and probably a lot of conversations with auditors and some back and forth there.
Yeah, for sure. I mean, definitely, it's an assessment that, depending on, how at risk the company may be of tripping that threshold, there's probably going to be lots of discussions and analyses done. It could involve conversations with people outside accounting. So even, working with legal, sales and marketing to the extent that forecasts and things like that are necessary. And then obviously, working with your auditors too, because kind of in tandem with management's assessment, auditors also have a requirement to do their own assessment as well.
Theirs might be a little bit less biased.
Yeah.
So you talked about the look forward period earlier, that 12-month analysis. Can you illustrate what that looks like in practice?
Yeah, sure. So we can, if we take like a calendar, let's use 2020, I guess, for example. So a calendar year in company, 12/31 is their year end. If they, let's say the management expects that their financial statements will be issued at the end of March. So March 31st, 2021 of the subsequent year. So from a going concern perspective, there's kind of two dates to keep in mind. One is the assessment date. So the assessment date is actually the date the financial statements are to be issued, or, in the case of a private company, are readily available to be issued. And then there's the look forward period, which is 12 months from that assessment date. So for that example, the going concern assessment would have to be from the year from March 31st, 2021 through March 31st, 2022, that 12-month look forward period. That's the period they would have to think about all those relevant conditions or events and kind of think about them in aggregate and whether or not over that period they have the ability to meet their obligations.
Yeah. So in practice, are they really waiting until the day they plan to issue their financial statements?
No.
Okay.
Yeah, everyone's like, all right, so I'm supposed to do this on the assessment day, but let's say I've got to go through this big exercise, or I've got a lot of things to think about and factors to weigh in, and I've got forecasts I'm looking at. So the answer is no. I mean, it's done as of the assessment date, but really, like, management is working on this assessment, obviously throughout what's considered the subsequent event period. So that's, end of the year through the date the financials, you have to do that subsequent event assessment. But during that period, they're also thinking about their going concern, the relevant event and conditions, Anything that's changed after the end of the year that is in
Right.
that subsequent event period that they need to keep in mind. So it's definitely it's a process that's kind of iterative throughout the close process, leading through the reporting process until the financials are issued, and gets continually updated. I think it's important though that management, they have a process in place to really kind of think about the events and conditions and capture those, involving, like we said, other stakeholders as needed,
Mm-hmm.
to the extent they need to talk to legal or others outside the organization itself, in order to evaluate some of that stuff. That's important to keep in mind too, because it does take time to do that.
Okay. And so a big part of this analysis is looking at relevant conditions and events. What are some examples of these conditions and events that people might look at?
Yeah, so there's a bunch.
Mhm.
I think the easiest way to think about it, and the guidance is pretty clear about kind of
Mhm.
4 distinct categories that you think of when you're looking at all those relevant conditions or events, that get broken down.
Mhm.
So the 4 kind of buckets or categories you want to think about. One is the financial condition of the company itself.
Mhm.
What are the conditional and unconditional obligations that
Mhm.
are due or anticipated to come due over that 12-month period? They need to think about just the funds in general to run
Mhm.
the business itself. So funds just to operate the entity over the next 12 months.
Yeah.
And then they have this like generic kind of catch-all, which is just the other categories. So
We
it's
love that other.
it's the other events or conditions that
Uh-huh.
you want to think about. And that's really to be done in tandem with some of those first 3 buckets. So there's never going to be anything in that other category alone that's going to
Mhm.
trip that substantial doubt threshold. It's going to
Right.
have to be kind of in the aggregate with some other stuff.
Okay.
I think one thing also just to reiterate here is that the FASB, you obviously consider known events because you know them,
Uh-huh.
but you also kind of have to think about things that you might not know that
Mhm.
that could come up. And so the FASB, they kind of have this term of kind of a like reasonably knowable, which is basically saying, hey, you got to make a little effort to think about more than what's just on paper or known today in
Mhm.
that assessment. But obviously they don't want you to kill yourself over having to
Try to
figure out.
predict pandemics and
Right, predict things that are just would require undue cost or effort is kind of the terminology they
Mhm.
use. So
Okay. Maybe we could spend some time diving into each of those buckets.
sure.
So the first one you said was the entity's financial condition. So what are they kind of looking for there?
Yeah, so entity's financial condition is really kind of looking at just available access to liquidity.
Okay.
So it's thinking about lines of credit that you
Mhm.
have and maybe available access on a line of credit. It could
Mhm.
also just be looking at liquid assets, so cash, obviously, or cash
Mhm.
equivalents that you could easily access. I think one of the important things here to think about is that especially in terms of like available credit, is it has to be like committed credit to the entity. So it's stuff
Mhm.
that's easily accessible that they could readily access, if needed. So plans to open a line of credit don't necessarily qualify,
Right.
as kind of an evaluation of that entity's financial condition and access to credit there. So
Yeah, because if they're in the process of negotiating a line of credit, let's say it's going to close on, use that March 31st date. What if it's going to close April 15th? Can that be factored into their analysis, or, you know, they might get it, or how does that kind of work?
yeah, it would really would depend if it's been committed. So like if the bank's committed to that credit
Mhm.
and the availability of that credit and it's been approved or whatever, then for sure. But I think the important here to think about is in step 1, you're looking at whether it's probable that substantial doubt has been raised. And so
Mhm.
if there's a plan to open a line of credit, that's really more of like a step 2 exercise,
Okay.
that you would evaluate, separate from the events and conditions that we're talking about here. So this is really like what is existing, what
Mhm.
is the existing financial condition of the entity itself, and what access to liquidity and things do they currently have.
Okay. The second bucket, conditional and unconditional obligations due or coming due. How would management evaluate?
Yeah, I think the best way here to think about it is really it's kind of twofold, I guess. I would think the first one is looking at kind of all the obvious ones, the contractual obligations, so things that you have to pay. So the most common ones and the big ones that usually make or break maybe an assessment is going to be stuff like your debt,
Yep.
Contractual payments due under the debt agreement that you have to make over that 12-month period. Another big one is leases. So if you got tons of leasing activity and you've got leasing obligations you got to satisfy, that's another one. Some less common ones could be kind of, purchase or funding commitments that you may have that are unconditional that you have to satisfy. So, where you're expected to put up additional funding because you're contractually required to do so. And then maybe a little bit less common because, we see fewer and fewer pension plans, but pension obligations are can be another large, thing you got to think about as far as contractual obligations. But then the other one, it would be just obviously the other side of the coin, which is non-contractual obligations.
Yeah.
And so I think the ones we think about in this case, and the most common one that probably be significant to a business could be, an example would be like a legal settlement. So if there's a large legal settlement that is known or expected to be, maybe your legal counsel has evaluated a range of what that settlement might look like, an obligation like that could also make or break a going concern assessment if it's significant enough.
Yeah. You don't want that. You don't want any surprises. The third bucket. Let's see. Third bucket is around funds necessary to maintain operations, which I assume has a lot to do with cash flow and even forecasted cash flows, right?
Yeah.
Okay.
So, you use the word forecast. Again, it's that judgment thing. So anytime forecasting is used, it's there's going to be a lot of assumptions made. So, most companies at least have a 1-year forecast. Generally most companies have like a 5-year forecast, but for sure, most companies are going to have a forecast of what their cash flows are going to look like over the next 12 months. And obviously, when you've got a forecast, like we said, there's just a lot of assumptions and things that go into that. So a lot more scrutiny that gets placed on evaluating those funds that are necessary and making sure those forecasts are kind of robust. I think one thing we often see sometimes with clients is that they don't reconcile their forecast. So a forecast using a going concern assessment, the assumptions there, you want to make sure that they are consistent with forecasts used in other parts of the business itself. So, if you think about other areas where forecasts are used, like a goodwill impairment assessment where you're forecasting cash flows, you wouldn't want to have too much disconnect between the two separate forecasts. You'd expect them to be similar. So just some things like that to keep in mind, but good reminder there.
And then that fun fourth bucket, the other catch-all, what kind of stuff falls into that bucket?
So that, like I said, it is the catch-all. These are usually sometimes more entity specific, just, other type conditions, or it could be more macroeconomic type things. So things we tend to focus on here are like, one is financial trends could be another relevant condition. So an entity's got a history of recurring losses or, negative cash flows from operations could be some examples of financial trends that are, pointing downward. You could have internal or external factors. So, labor issues, global pandemic for sure, laws or regulation changes, things that are within the control of the company, but also things that maybe are outside their control. And then there's just kind of, even within the other, there's another other. So it's just like other indicators of financial difficulty. So like if an entity knows it has to refinance its debt, not to be non-compliant, that's obviously going to be an adverse factor that, could be relevant too.
Okay, so they look at all of these factors in the 4 buckets.
Yep.
And they get that dreaded substantial doubt, everything they hoped would not happen. So they move on to step 2. What happens in step 2?
Yeah, so substantial doubts raised. So now they got to move.
Such a bummer.
Move on for sure. Never a scenario people like to be in, but unfortunately, it is a reality. I think for a lot of businesses, a lot of companies, especially in 2020, and likely could even be in some of the early parts of 2021. But it's then evaluating whether that substantial doubt exists. And so this is where then you need to consider, all right, what are we going to do as a company to help overcome this doubt? What kind of plans or actions can we put into place, or have we already put into place, that will allow us to kind of overcome that substantial doubt so that it doesn't exist over that look forward period.
Okay. What types of action can a company take to mitigate those risk factors?
Yeah, so there's probably 4 kind of, I would say, the most common ones that are done, and obviously they're the most obvious things you would tend to think of. So, one could be, selling a part of the business or selling assets to raise liquidity and get access to cash, more or less. So that could be one possible plan. On the flip side, there's also like borrowing more cash. So trying to either restructure existing debt, take out new debt, extend available lines of credit, things like that. So borrowing additional money. Sometimes it's looking at cost savings. So, maybe we can't raise more cash, but we can keep more cash from going out the door. So it's delaying certain costs or reducing expenditures. So if you had large fixed asset projects planned, maybe it's scrapping those or putting them on hold for a little bit. Or, a lot of what we saw in 2020 was like a lot of companies were, reducing raises or bonuses, or a lot of, employee benefits were cut and things like that. So just ways to save some cash with the reduction of expenditures there. And then the last one is just through equity. So just, issuing additional equity interest in the company to raise capital through equity.
Okay. And this might be kind of a silly question, but how does bankruptcy play into all of this? Like if they were to file for a bankruptcy?
Yeah. So,
I went off script. I'm really curious on that one.
No, I think that's a good question. I mean, obviously, as part of bankruptcy, I think bankruptcy is a event or condition that points to going concern. So it's probably already going to have been, as you lead up to that bankruptcy and you're filing for bankruptcy, you've probably already like gone through the going concern assessment. It's pretty rare that in the prior quarter, everything would be great, nothing. And then all of a sudden the next quarter you're in bankruptcy court. So you tend to think that they're not saying that it couldn't happen that way, but there's usually a little bit more, I guess,
chicken
like I
or
said,
the egg, the egg comes first in this
it comes back to that early warning thing. So hopefully there was enough warning kind of showing deterioration that led to that bankruptcy. But when you're in the bankruptcy, obviously there is already substantial doubt because you can't meet those obligations and you're trying to restructure those obligations and hopefully come up with a plan that gets you out of that so you can reemerge from bankruptcy.
Yeah. That was just pure curiosity.
No, I love it. So maybe stepping back to management's plans, I think one thing to keep in mind is you can't just come up with all these, pie in the sky type plans of we'll achieve this, we'll do that. The guidance is really specific about setting a high bar for what qualifies as a plan that management can put into place that would help alleviate the substantial doubt. And so that's one thing to keep in mind is that, that it really is a high bar. It's a high threshold to allow some of those plans that management may be thinking of to actually count towards the evaluation of step 2.
Okay. And so there are 2 considerations maybe for high bar. Looks like will be effectively implemented and will address the relevant conditions or events that gave rise to the initial substantial doubt.
Right. So any plan they come up with, they need to be sure that one, it's feasible, that it can be effectively implemented. So you can't just, like I said, well, we're going to raise all this additional capital. Well, if, that sounds great on paper, but, that actually has to happen. So you got to have, investor interests that want to do that, or, we're going to restructure our debt with the bank. Well, if you haven't talked to the bank and haven't really kind of moved forward with that process, it's really hard to argue that that's feasible, that it'll be effectively implemented. And then again, even if it is implemented, it has to also address whatever event or condition in step one that was really kind of tripping you up. Is it timely enough to really kind of address that event or condition? So if you've got obligations coming due in Q1 and your plan is we're going to sell a part of the business, but that sale isn't going to occur till in Q3 in your look forward period, then it's not necessarily considered it addresses the relevant condition or event. So that wouldn't count towards mitigating kind of that substantial doubt.
Okay. And then how does a company's past performance play into that assessment of whether they can feasibly carry out their plan?
Yeah. And I think this is what some companies maybe take a little too much liberty with. And I think this is where you tend to see auditors even push back a little bit, is that it can factor in depending on who the counterparty is. So like a lot of times, companies have a history of negotiating changes in debt with their lenders. They've had a long working relationship, and the lenders have usually been agreeable with that. It's still relevant to kind of think about that, but it's not safe to assume that it's always enough. To say like, we've done it before, we plan to do it again. We'll get to that when it matters, in that look forward period. But right now we haven't done anything. That's not going to be enough to kind of meet the high bar for a plan to mitigate substantial doubt if it was raised. And it's really because, especially when it comes to creditors and things like that, is that, their ability to maybe extend credit or waive a covenant or something like that, that was probably based on facts and circumstances in the past. And obviously in today's climate, when economic conditions are not as great and credit markets have sort of deteriorated, lenders may not be as willing to, kind of work with companies as they had in the past. So it's just something else to keep in mind.
So you can't overly rely on the past. It might play in there a little bit.
Right. Yeah. Best practice is you're already working with that lender. You've got the approvals in place, or, there's enough evidence that really kind of shows that, hey, this will be effectively implemented. We're currently in the approval process for whatever we need from our lender. And it's more so than saying, well, we've done it before, so we plan to do it again.
Okay. And so I guess from step 2, we have kind of 2 outcomes. Either you've mitigated the doubt or you haven't. Can you kind of talk about what happens in each of those scenarios?
Yeah. So, and maybe even circling back to the top of our discussion about like the accounting, does it change the accounting? And we said no.
Right.
And that's really because going concern, it's, we said early warning, but that early warning really just means it's a disclosure type standard. So regardless of whether those plans mitigate or not, once you get to step 2, you're always going to have some level of disclosure in your financial statements.
Okay.
And it really just depends on what that disclosure will look like, whether or not those plans mitigated that substantial doubt. So to the extent they have mitigated the substantial doubt, the disclosure can be a little bit more abstract. It's usually going to kind of speak to principal conditions or events that kind of gave, rise to the initial doubt. Talk about, why those are significant to the financial statements and the entity as a whole. And then, you might have a discussion about what plans management effectively implemented to mitigate that. But that's really all that's disclosed. On the other hand, if substantial doubt exists because the plans don't mitigate it, then there's a requirement that an entity explicitly has to state that there's substantial doubt about their ability to continue as a going concern. So they have that more blanket statement, which you do not have to state if your plans mitigate. You don't have to say our plans mitigate this and there is not substantial doubt that we will not continue as a going concern. You don't have to argue the other side.
It would start to get confusing if you did that.
I know, I had to make sure, I don't even know if I said that correctly, but so it's a little bit more, like I said, of an abstract disclosure, not as explicit about that.
Okay. And so not only management cares about going concern, we have our friends, the auditors, who also care about going concern. Could you talk a little bit about the auditor perspective? Yeah,
sure. So, like I said, the going concern standard for management is relatively new. Like I said, I think it's been effective since 2017. But going concern has always been like an auditor concept for numbers of years. I think back to the 70s or 80s. I don't remember the exact specific date, but it's always been a part of not always, but it's largely been a part of the auditing standards for a long time now. So it's something your auditors have always focused on. It's for them to perform their own independent assessment. Obviously, they're going to review management's assessment as well. They're thinking through a lot of the same framework, just to understand the conclusions and make sure the conclusions that management reaches is the same that they reached, and there's agreement there, because it can have implications on the auditor report depending on the outcome.
What would impact the auditor report?
Yeah, so if substantial doubt exists, there's a requirement under both PCAOB and AICPA auditing standards that they have to include either an additional paragraph or an emphasis of a matter paragraph that states that there is substantial doubt. So not only will management have that somewhere in their footnote disclosures, but it'll also be, on the face of that audit report, there'll be an additional paragraph that'll, state the same thing.
Is there anything else as we wrap up? Any more pressing matters about the going concern?
Yeah, I probably would just add one more thing about the auditor, like the additional paragraph. I think a lot of people get a little worried that if they have that additional paragraph, then perhaps the audit report is considered like a qualified report or a modified report. And that's not the case. You can still have an unqualified, unmodified report, even with that additional paragraph. It doesn't change the opinion of the auditor. It's really just to draw attention again for the users of the financial statements about the matter. And then the only other thing I would, kind of ask, management teams not to forget is just around internal controls. And just making sure, especially this year with forecasts and a lot more scrutiny being placed on going concern, is just making sure they have a lot more kind of robust process around the evaluation of the assessment, making sure, information that they're using, obviously complete, accurate, always accounting buzzwords you want to keep in mind. And then to the extent that there's, reviews in that assessment process, is just, making sure that the level of scrutiny in those reviews is appropriate, especially in light of the circumstances this year.
Yeah, it's always important to remember controls. Well, if you made it through 30 minutes of accounting talking and you want to know more still, you could go to ASC 205-40, or we'll have some blog posts on our website that might be helpful. You can find these in the episode description. Thanks for tuning in, and we hope you found this discussion helpful. Come back soon for more Accounting Matters.